Hi, everybody. We're going to get started in just a minute. Hi, everybody. My name is Michael Kimmel. I'm the Executive Director of the RPB. I'd like to welcome you to our second participant video conference call. Today, Len Teitelbaum, the chair of our board, will be offering some opening remarks in just a minute. He's the gentleman to my right, followed by David Baskin, who will offer an update on plan performance and some other changes to the plan. David will then turn it back over to me, who I'll spend some time going through some enhancements to the Reform Pension Board and some major changes coming up over the next year and a half. And then I'll close by offering some comments about the participant survey that many of you participated in. I want to thank you for that, as well as to respond to some questions that did come in from you. So with that, I'd like to turn it now over to Lynn for some comments.
Thank you, Michael. On behalf of the board, I would like also to welcome you to the second installment of our conference call program, which is designed to keep you informed of what we are doing for your benefit and your benefits. For those who took the time to fill out the questionnaire that was sent several weeks ago, I want to thank you and tell you that your responses will help draw the roadmap for us to proceed in a responsive and responsible way. Michael will have much more to say about this, as he indicated a little later. Now, this call will be somewhat different in scope than our last one, as we intend to utilize the next 45 minutes or so to inform you of some of the enhancements we wish to unveil and or implement over the next year to year and a half. But before we get to the preview stage, I would like you to know of some of the changes that have occurred behind the scenes and beneath the numbers. There's no secret that technology has greatly enhanced and advanced over the last few years, offering us, your RPB, the ability to do things we could not do in the past. Michael and I decided that in order to accomplish our goal, we must take advantage of what is now available and modernize in order to enhance our program and deliver what we and you, the participant, want. We have approved, the board has approved, I've recommended, Michael has recommended, presented to the board a major program of investment into our systems. For instance, we could not move to a more rapid valuation process with the capability we presently have, nor, could we move to a more popular, broader choice selection option, nor could we institute new or unique enhancements that I'm particularly enthused about. But I don't want to get ahead of myself and overpromise and underdeliver. We'll have more to talk about that later. Modernization relies on two factors: internal computer systems and personnel. Michael has expanded the outreach to participants by adding staff with different skill sets needed to accomplish our goal of being even more proactive than in the past. Alice Gunn, your CFO, is moving the systems along as fast as prudent. Michael and I want this to be done right over fast. I hope you agree. Now, speaking of Michael, that's him. One of the reasons he was selected as our executive director was his intimate knowledge of both the congregational side of the equation and the in-depth experience dealing with the various cohorts of the plan. In addition, Michael understands systems, but in my mind, and almost as important, Michael knows when he needs outside expertise to accomplish our agenda. I'm pleased to say I and the board are not disappointed in our choice. From an investment point of view, we are over 90% of the way to accomplish what we need to expand and enhance the investment part of our agenda. The rest depends on the integration of the new systems. Do I wish it could happen tomorrow? Of course, but this is a difficult task. But it will happen. That is my pledge to you as chair. I would now like to have David Baskin report on recent results and then have Michael fill in the blanks and flesh out the comments I have just made. David?
Thanks very much, Len. Ladies and gentlemen, before you, you'll see a slide that shows the performance for the calendar year to date up to the end of July for the four components of the RPB. On the far left, the Capital Appreciation Fund in blue is compared to its benchmark. And as you can see, for the year to date, we're about 0.3% above our benchmark. Similarly, the Appreciation and Income Fund in yellowy orange also outperforming its benchmark, as is the Income Focused Fund in green, in fact doing relatively the best of all, 0.4% better than its benchmark. And finally, the Capital Preservation Fund in red in the bottom right-hand corner, returning less than 0.75%. And I'll have more to say about that in the future. Let me say this, 7.75 or 7.5 or almost 7% for the first 7 months of 2016 is a great result. It's in marked contrast to how we did in 2015. And it may be more than we can expect in most years. The thing to understand about the investment business is that it's not linear. Results vary widely from year to year. They vary widely from asset class to asset class. And we're not doing anything differently in terms of our methodology than we are last year. But as you can see, the results are remarkably better. Michael, could you go to the next slide? Or Maria, thank you. So this slide shows you the various components of the Capital Appreciation Fund, and it compares their return to the return of the entire fund. The horizontal black line shows you the return of all the asset classes put together, 7.7%. And by looking at this graphic, you can see that our best asset class in 2016 is the emerging market equities. Now, not surprisingly to those people who have been around the investment business a long time, emerging market equities were by far the worst asset class in 2015. So what we're seeing here is what you might call a rebound, what economists call a reversion to the mean, and what we call the advantages of diversification. What cost our participants money in 2015 has made them money in 2016. And as you can see, the return by asset class varies widely from the emerging markets, the real estate investment trusts returning 18.3%, the master limited partnerships, which were very bad last year, returning 13.6%, and so forth, all the way down to the categories, two of which have a negative return for the year to date. The point is, diversification is a prudent strategy. It's a strategy that pays off over time. And just because an asset class has worked out badly for a period of time does not mean that we should abandon it. We should continue to diversify our assets. Could we go to the next one, Michael? This is the Income Focused Fund. It has fewer asset classes than the Capital Appreciation because it's focused primarily on getting a solid income return. Traditionally, the province of this kind of fund has been bonds. And by far our largest component is the third from the right, the core fixed income. This is basically debt obligations of governments and corporations that pay us a rate of interest. Tips beside it is Treasury inflation protected securities. And the other categories are add-ons, are things that we've put into this pot to enhance the returns. You're going to hear more today from me about the very low interest rates that investors around the world are living with. As you probably are aware, in Europe, interest rates have actually gone negative. So that if you buy a bond issued by, for example, the Bundesbank In Germany, it pays a negative return. Similarly, even some good corporations are able to borrow money essentially at zero interest. This is a very challenging environment for income-focused products. And we've enhanced our returns by adding such things as master limited partnerships, global risk, global sovereign debt, and U.S. dividend equity. And that's what's allowed us to outperform the benchmark in this area. Michael, could we go on, please? I want to talk particularly about the Capital Preservation Fund and the challenges faced by our participants who are looking for 100% safety, a guarantee that their capital won't be eroded as a result of poor investment returns. On this graph, the change in the consumer price index from year to year is shown in the red line, and the change in the yield, the annual profit on our capital preservation fund, is shown in red. The oval on the right-hand side of the chart shows you the problem that we're facing in this area. Basically, as the returns on the capital preservation fund have fallen below 2% because of very low interest rates, consumer prices have actually risen faster than the return on that fund in the majority of periods in the last 6 years. And what that means is that the real purchasing power of funds invested in capital preservation is being eroded by inflation. Now, I'm sure that lots of our participants, not only on this call, but in particular those in the Capital Preservation Fund, will remember the period of, say, 1976 to 1981, when inflation reached very high levels in North America, over 13% at the peak in 1979 and 1980. We're not facing inflation at that magnitude. Inflation right now in the United States is probably at about 1.5 to 2%. But the return on our capital preservation fund is less than that. It's less than 1%. So that even if inflation is only 1%, the real return for investors in capital preservation is negative. That is to say, the very object of this fund, which is to preserve capital, is not being achieved. So this is a real challenging period, and we don't know when it's going to change. Economists suspect that the Federal Reserve will increase interest rates probably in December and once or twice or more in 2017. But in the meantime, this is a unprofitable product for participants. Michael, next slide, please. One of the challenges when looking at investments is to avoid being focused on the present. All of us, to one extent or another, run the risk of what cognitive psychologists call recency bias. We look at what's happened recently, what we remember the best. In the investment field, this is a very dangerous problem, and it's a real problem for managers because everybody wants to know what you did for me recently. Well, recently, in 2016, as you can see in the column on the left, we've done very well, thank you. Over 1 year, less well, and we know a number of participants were disappointed in our performance in 2015, as were we. But if you look at the 3-year period and the period since inception, what you can see is that returns have been very close to the benchmarks and more in line with what I expect participants' long-term expectations are. I think it's certainly in the mind of the investment committee to avoid recency bias, to keep our minds focused on returns over periods of 3 or 5 or even 10 years. And I would urge participants, when looking at the returns, to do the same. Michael, could we go to the next one, please? Of course, returns are only one half of the investment equation. There's also the question of risk. Risk is a tricky concept in investments. It's hard to measure. It's hard to know what a good proxy for risk is. Most investment managers use volatility as a proxy for risk. Volatility is how much things go up or down, how much the value or the price in the market tends to change from period to period. And the assumption is that the more volatility, the higher the risk. Obviously, stocks, which go up and down second by second between 9:30 and 4 o'clock from Monday to Friday, have a lot of volatility. Things like real estate and government bonds have much less volatility. By offering our participants a number of possible investment strategies ranging from the most volatile in the capital appreciation fund to the least volatile in capital preservation, followed by income focused, we allow participants to choose the level of risk which they find most suitable for themselves. But the point of this slide is to show you that through selection of managers and prudent diversification, in each of these products, we are experiencing volatility less than the benchmark. In other words, the selection of managers has lower risk than the overall market in each of these three products. In the case of capital appreciation, the volatility is almost 1 full percentage point less over the 3-year period since inception, and similarly as we go through the other products. So combination of two things we're focusing on here, not only return, but also risk. Our object is to get better returns with less risk. That's kind of the El Dorado in the investment world. Difficult to do, but what we're trying to do. Next slide, please. The portfolio changes that I'm going to detail here have been managed by the investment committee really over a period of about 6 months. We're undergoing what is certainly the most radical and wide-ranging, sweeping series of changes in the portfolio, certainly that I've experienced in my about 20 years on the investment committee. So what are we trying to do? In the first place, we're shifting from active management to passive management. What does that mean? Active managers are stock pickers, they're sector pickers, they might be country pickers, but the point is they don't buy the whole market, they buy what they think will do the best. Passive managers buy the whole market. They say, it's impossible over time for me to add value by trying to pick companies or sectors. We're going to buy the whole market, and if it goes up, we'll go up in a like amount. Now, I know that some participants feel that passive management is a better strategy than active management. In discussions with our strategist, Summit Corporation, out of St. Louis, we've come to the conclusion that in some categories, in particular, large capital domestic companies, the biggest companies in America, such as Apple and Google and General Electric, managers probably cannot add much value. So as you can see in the first box at the top of the page, we have terminated 3 active managers, Eagle, Brown, and Northern Trust, and instead taken those funds and put them into a passive index product, the Vanguard S&P 500 Index. This means that that portion of the portfolio will mirror the index exactly, and I have to tell you, this is a very low cost product compared to active management. The second thing that we've done at the investment committee, and Michael will be talking more about this as he goes along, is to shift from monthly valuing of the portfolio to daily valuing. We know that many participants would like to know what their portfolio is worth, not just following a month end, but on a regular basis. Many of the managers that we were using were unable to provide daily valuation to us. And that's meant that we've had to change those managers, and in some cases change products to others that can provide daily valuation. In the box at the bottom of the page, you can see that 5 managers have been terminated and replaced with 4 other managers, which allow us to have daily valuation. This is a big upgrade. So I've used up my time. Let me say this. This is a time of dynamic change in our investment products. We've listened to our participants. We've done a number of things which we think will not only enhance yield, and as Michael say, enhance their experience, but also reduce participant costs. The effect of changing our management lineup has been to reduce our load, the participants' cost, from 68 basis points or 0.68% in capital appreciations to 0.5%, a significant savings. An appreciation in income, a similar savings, and an income-focused, a smaller saving, simply because it was a less expensive product to begin with. That's my report, and I turn it back to you, Michael.
Thank you, David. Great report. We really appreciate it. So now I'm going to change gears a little bit and talk with everybody about some of the enhancements and changes that we're planning to make over the next 12 to 18 months. These changes are designed to enhance your experience and to give everybody the tools, resources, and knowledge necessary for everyone to take full ownership of their financial future. And we're not only keeping in mind the participants who are on this call today, but all our constituents, including your congregations, employers, and our movement partners in the work we're doing. This is really a full encompassing project and program that we're getting started on. Before I get started and walk you through some of the changes coming, I do have two related announcements. First, our longtime communications manager, Deborah Feldman, has left the RPB as of the end of August. I know that many of you know her and know the great work she did for the pension board over these many years. We really do truly wish her well in the future. Taking over for Deborah in a greatly expanded role is Stephanie Berger. She actually just started yesterday as our first Director of Marketing and Communications. Stephanie brings many years of experience to this role, including many years working in financial services, the synagogue world in communications, as well as consulting to external organizations, including ours. She's also an adjunct professor of marketing at Adelphi University. Stephanie will be leading our efforts to build out and run our communications and education functions. We welcome Stephanie to the staff. So, first up, and of many things that are coming down the road in the next year and a half. First is the enhanced Info Express website. As you have probably heard, in fact, today, we are entering a blackout period between now and next week, September 13th, when the conversion to the new Alaris system will be completed and the new website will come online. So what are we going to have day one, starting next week? First, we're going to have a much more intuitive website with enhanced calculators. It'll be easier to navigate and find what you need. Secondly, we're going to have, we've turned on the feature with Alaris to enable everybody to see their personal rates of return. Now, it's important for everyone to understand that for those in the plan since before 2006, so anyone who started prior to 2006, we will only be able to provide returns since 2006. And of course, those that started after 2006, they'll be able to see their rates of return since they've been in the plan. These returns only will factor in contributions and distributions, but not rollovers to the plan. The next thing that you'll be able to see starting day one is that on your quarterly statements, the administrative fees will be broken out. This is something new that we have not done before, but actually is pretty common for retirement plans to break out the administrative fees, not the investment management fees, but the administrative fees that we have to charge to run the plan and make everything work. Starting for August, you will actually see the column, but there won't be any data in it yet. It won't be until September when we'll be assessing the first quarterly fee that you'll see what those fees are. And then therefore, and then every quarter thereafter, you'll see the fee assessed. A little bit later, you will be able to do a lot more and include details on your investments by asset class. What does that mean? That means that you'll be able to see how your portfolio is allocated across all the asset classes that underlie the existing funds that we offer. So for example, if you're invested in the Capital Appreciation Fund, Today, you only can see that you're invested. You know, there's a pie chart on the website that shows one number. In the future, that'll be broken down by the individual asset classes: large cap domestic, small cap international, etc. So you'll be able to see a little bit more detail. In addition, there'll be additional flexibility to change your investment elections. You'll be able to customize, for example, how you want to allocate your current balances versus future contributions. Today, all allocations, all money is allocated the same way. In the future, there'll be more choices and options for you. And then the third enhancement coming later on is for those who are retired and taking distributions, you'll be able to select specific funds from which those distributions will come, as opposed to the account in total. We've had a number of requests for that, and we're excited to be able to roll these changes out to you. There's a lot to do, and so as we move forward, we'll certainly be announcing when these changes will come live. We hope that some of these changes will happen by the end of this year, but stay tuned. We'll provide as much information as soon as we know it. Next up, expanded investment choice. Earlier, Len Teitelbaum made mention of our abilities to grow the opportunities for you to select the investments you want beyond what is available today. So in the late fall or early winter, we'll be adding a selection of 9 Vanguard index funds to complement, not replace, but to complement our 4 existing professionally managed funds. They run the spectrum from equities to fixed income to real assets in the form of real estate investment trusts. Now, very briefly, what is an index fund? David alluded to passive investments earlier. Most passive investments are in index funds, and they usually fall into the category of either stocks or bonds. I know some of you know this, so please bear with me. Not everybody has the same level of understanding, so I just wanted to take a second to explain what this means. A stock index fund, for example, will invest in the companies that comprise a particular investment index, such as the S&P 500, which consists of the largest US-based companies. Other index funds will invest in other indexes that represent different financial sectors or markets, and I'll show you what those are for you in just a moment. So what does this mean for you? First of all, participants can self-direct their portfolio to meet their unique financial needs beyond what our current offerings can do today. Second, this approach may appeal to participants with a particular interest and knowledge to make the allocation decisions on their own, or for those who use professional financial advisors. And you'll have maximum flexibility. You can keep things as they are today in the 4 funds we offer. You can switch and invest solely in the new index fund offerings, or you can actually invest in a combination of both. So, first up are the stocks or the equity funds. These are the 4 funds that we will offer, and they run the gamut from large established US companies in the S&P 500, all the way through emerging markets fund, which are large, mid, and small companies in the developing markets outside the United States. Brazil, Russia, India, China are, even though they're very large economies, they're still developing economies and have a different type of risk and investment profile, and which is why we have a separate fund offering for them. So hopefully these meet the needs of those that want to customize their portfolio on the equity or stock side. On the fixed income side, we also have 4 offerings that run the gamut of the total bond market fund all the way to a short-term bond index fund and everything in between. Again, these are the basic profiles of different types of investments and different types of asset classes. We could have offered 50 different funds, but one of the things we know is that sometimes the more choices you have, the harder it is to select. We wanted to make sure we had enough choice to give people the chance to customize without going overboard. The last option, the last choice I should say, is a real estate investment trust index fund. And this is a fund that invests in companies that own and operate real estate, buildings, shopping malls, hotels, etc. This is the type of investment that investors typically include in a portfolio to further diversify their portfolio. You saw earlier when David talked about our portfolio that we also invest in real estate investment trust fund. So just to recap, those are the new fund offerings. And just to remind you, these are the existing fund offerings, right? Don't forget, we have a capital preservation fund, which its goal is principal stability, although, of course, with the way interest rates are going, it becomes challenging, a little bit more challenging in terms of maintaining purchasing power. The income-focused fund for those seeking income generation, the appreciation and income fund, which is a mixture of the income-focused fund and the capital appreciation fund, and of course the capital appreciation fund, which its objective is for those that are seeking to grow their assets and typically have longer time horizons. So again, these are in addition to, not instead of. Everybody will have the same choices they have today, with the new choices coming a little bit later this fall or early winter. In terms of what's next, right now, there's no need for immediate action. We'll be sending out an official announcement right after the high holidays, followed by a detailed investment choice guide, along with a specific go live notification a little bit later this fall. We still have some work to do, and once we know the date for sure, we will let you know. Next up, and other great enhancements that are coming a little bit later. First of all, we have the daily valuation of our portfolios. As you heard from David earlier, we're going to be moving from a monthly valued environment where accounts are only updated once a month to a daily valued environment where your account will be updated and valued every business day when the markets are open. It'll reflect gains and losses, it'll reflect contributions and distributions and all other account activity every day that these transactions happen. As I mentioned, contributions, they'll be reflected in your account more quickly than today, but not necessarily immediately upon receipt. We still are going to need a little bit of time in the office to process and apply these payments. So we hope to get all these contributions in as soon as possible, but you have to understand that processing still takes a little bit of time. In addition, changes to distributions or new distribution requests will be processed more quickly than today. Today, those that are retired already know this, a request to make a change to the distribution can take 1 month or even more, depending upon the timing of when that distribution request is made. This will change everything as far as that is concerned. And then changes to the allocations will be effective the day after they're submitted, not at the beginning of the following month. So all these things will happen, not real time, not same day, but usually next business day or next market day. Of course, the only exception to that is when the RPB office is closed for the Jewish holidays. So we can't help that. Very important to understand that this is one of the largest and most complex changes we've ever made. We've already begun, but it involves updating not only our own technology, but the technology of our partners in Alaris, our record keeper, and Northern Trust, who is our custodial bank. All our systems have to talk to one another in a very different way than they do today. This is going to take a little bit of time. We'll provide updates as things progress, and we're hoping sometime next year that this will, we're not hoping, we know that this will happen sometime next year. When we have a date certain, we'll let you know. Next up, redesigned website. We have plans to overhaul the website either later this year into early next year, making information more accessible and easier to use. We want to be able to provide a more up-to-date user experience. We want to and will provide more effective tools and resources. We will make it easier for you to manage your account. And we will make our website accessible, truly accessible from any device, mobile-friendly, laptop, iPad, whatever. Our website will have a lot more capabilities and be a lot easier to use. We're very excited for the chance to update this for you. We're also going to be providing additional educational content and tools over the next year to year and a half. We recognize that people are in different stages of their retirement journey with very different needs. We also know that everybody has varying levels of investment knowledge, understanding, and interest. So with that in mind, we'll be developing the content, the resources, the tools, building out our website to meet you where you are. We want to make things as accessible as possible and recognize that we're going to have differentiated information based on who you are, where you are, and how interested or knowledgeable you are. That's very, very important. And lastly, for now, is we're actually have already begun enhancing the technology underlying our customer service processes. We've already been upgrading and replacing our in-house systems, and we want to make sure that we're as responsive and as possible to your requests and needs. Technology, putting the right technology in place is a major step in that direction. Of course, as Len mentioned earlier, having the right people in place is just as important, and we're really happy with the folks that we have in place to support that function. So we're very excited to launch these enhancements over the next year to year and a half, and we know that this will make for a much better RPB. But we also know that the work is not done and will never really be done. Now I'm going to move on to talk about the participant survey and also respond to some of your questions. So as you know, we just completed a survey to assess your satisfaction with the RPB and also learn more about how you think and feel about your retirement. It has given us additional depth and quantified what we've been hearing from you all along. So a little bit about the survey. So the survey just closed last week on August 25th. Nearly 20%, or almost 500 people, participated in the survey, which is really incredible. And I want to thank everybody on the call or who will be watching this later on when it's posted up on our website for participating in the survey. Your responses have been extremely valuable and will be very valuable. We have a lot of work to do to analyze the data and understand more about what you've told us. And we know that it will provide a very much feedback on where we're headed. You should also know that we've surveyed congregational lay leaders as well as employers, because it's very important to hear from them as well. Early feedback, both good and not so good, not surprising. And we know that there's room for improvement, and we're working very, very hard to get us to even that next level. And it's also important to, we just didn't want to understand how you feel about us. We really needed to understand a lot more so that we can use this information to inform our current and future strategic direction in terms of the products and services we offer, the way in which we communicate and educate you, the way in which we work with you on service and support, as well as the employers and the support we provide to them. The work is never done. Look out for additional opportunities to provide feedback in the future. We want to make this an ongoing conversation with you. This is your plan, and we take it very seriously that we want to keep this conversation going. I'd now like to answer a few questions that have been submitted to us. First question, I'm 76 years old. Why is there a restriction to a 60-40 stock to bond allocation for people in my age category? Well, actually, for folks over the age of 60, there are absolutely no restrictions. Anybody can invest in any of the 4 funds we have today. Of course, there'll be new choices coming very soon, but today there are absolutely no restrictions for anybody under the age of 60. The only restriction we have in place today is that no more than 80% can be invested in the Capital Preservation Fund for those people under the age of 60. So again, no restrictions at all. Next question. Excuse me. I'm a rabbi. Can I continue to contribute to the RPB if I no longer work for a URJ congregation? Yes, actually. If you maintain your CCAR membership and you work for a nonprofit, typically in a rabbinic role, and they send us the check, you can continue to participate. Rabbis just can't work for a non-URJ congregation. In fact, nobody can participate and continue to contribute while working for a non-URJ congregation. One other thing I want to clarify is that that doesn't mean that you can't leave your money with us. We've seen some instances where people think when they leave their job that they have to take their money with us, with you. You do not need to do that. You absolutely can leave your money with us through retirement. As far as NADA participants and ARJE participants, we do have some policies in place that enable you also to continue to contribute. They're a little bit complicated, so what I would do if you're a member of NADA or ARJE and you have questions about that, please contact the office. We'll be happy to answer those questions. Next question. What are the investment options for retirees? Well, as I just mentioned, we actually have no different options for retirees versus non-retirees. We don't differentiate, and neither should you. in terms of how you decide you want to allocate your assets. Again, it's only the under 60 that there's a small restriction. As I said, it's the same as everyone else. Why can't my RPB account be linked to, for example, Mint or Quicken? Actually, they can. It's very interesting. I personally use Mint, which is an application I have on my phone, which actually aggregates all my bank accounts, investment accounts into one place where I can see everything in one. I could see everything at once. I added my RPB account to it, and I could see it updated, yes, once a month. Of course, in the future, we'll have that daily, but I can see it every day. As far as Quicken is concerned, people today and in the future can log on to the InfoExpress website and download the Quicken, download your transactions and import them into Quicken. So, in fact, they can do it. I believe actually that's our last question, and also concludes our talk for today. I really want to thank you for participating and joining us today. I'd like to wish everybody a Shana Tova and a sweet New Year. Before I turn it over to Len for some closing remarks, you see in the background right there, I just want to ask and remind you to please complete the quick survey we're going to send out a little bit later on. We really need your feedback and want to make these presentations and these calls as effective as possible. So I'm going to step aside and let Len make a comment or two.
Thank you. And we really want to thank you all for taking your time out to listen to the call. And in preparing for this call, I particularly want to thank Rabbi Lenny Schoolman. Now, for those who don't know that name, he was the go-to person in the olden days when we were the UAHC. He's a storehouse of suggestions and knowledge, and is a wonderful person to work with. Lenny, todarabah. Now, as I said in my initial comments back in January, my goal is to make sure that you knew that this was not your old RPB pension board. We listened and we will continue to listen. Now, listening is one thing and doing is something else again. I intend to do both and encourage the staff here, as they have done, to do that as well. As a team, we've accomplished much in the last few months, but hang in there, there's more to come. And while it may be premature, as mein Zedek, Rabbi Chaim Chaimovich, used to say, Shana Tova Tikotevu, we wish you all a very healthy and good new year. Thank you, and we will have more to say at our next call. Shalom.
Bye, everyone.